Welcome to vTalkInsight, Market Drivers Daily for August 25th, 2026. Geopolitics, AI, and bond yields are colliding today, with sanctions, tariffs, and a pivotal Nvidia earnings test all feeding into an already uneasy Treasury market. Let us start with how the latest geopolitical moves are filtering through energy, currencies, and trade-exposed sectors. Geopolitics is again a primary macro driver, not just background noise. Washington is tightening economic pressure on Iran while also ramping up tariff threats toward both China and Canada, and these levers are rippling through energy prices, safe havens, and North American supply chains. The U.S. Treasury has rolled out new sanctions on dozens of entities linked to Iran and is signaling that a large financial institution could be targeted by the end of the week. So far, enforcement has focused on smaller Chinese and Hong Kong intermediaries, deliberately avoiding major Chinese banks and broad secondary sanctions, which keeps systemic risk contained for now. China, which absorbs the bulk of Iran's crude exports, has warned it will retaliate if its energy trade is hit directly, yet also signals a preference for escalation and ongoing cooperation ahead of a high-level U.S.-China summit. That tug of war is central to whether sanctions remain a gradual squeeze or turn into a genuine financial shock. In the Middle East, oil flows through the Strait of Hormuz are running well below some official estimates, and global inventories are down sharply after years of disruptions. Gulf producers and major oil companies are accelerating alternative pipelines, storage, and ports, which slowly reduces Iran's leverage over the choke point. Near term, however, any further tension around Hormuz or new transit rules from Iran or Oman could still push oil and diesel sharply higher, especially given existing refinery bottlenecks. Markets are hedging that risk with a stronger U.S. dollar after sanction headlines and the strongest monthly rally in gold since the late 1990s, even as Brent has slipped back below $90 on signs of diplomatic progress. Trade frictions with Canada add another layer of uncertainty. U.S. tariffs on Canadian autos and parts have been lifted to 50% on around $20 billion of trade, and Canada has responded with matching levies on U.S. dairy and steel, plus a multi-billion Canadian dollar support package for affected firms. Only a small share of total bilateral trade is covered so far, and both sides appear reluctant to jeopardize the core North American trade agreement. Even so, heavily integrated auto supply chains face a scenario where if tariffs extend to more parts, plants could be idled within days, with potential spillovers to employment and regional credit risk. Investors still see a low probability of a full-scale rupture, whether that is a new Cold War-style split with China or a breakdown of the USMCA framework. Sanctions on Iran are unfolding in phases. The U.S. administration is favoring economic pressure over military action, and tariff levels on Chinese goods are being calibrated to stay within what Beijing has previously tolerated. The main tail risk is a move against a major Chinese bank, which would likely trigger an acute dollar liquidity squeeze and broad market stress. Key watch points now are any escalation in secondary sanctions, the tone of the upcoming Trump-Xi meeting, energy inventory trends, and the evolution of the U.S.-Canada tariff dispute. Against that unsettled backdrop, the AI complex remains the dominant growth narrative in global equities. The AI story is still doing most of the heavy lifting for equity markets, but the focus is shifting from pure upside to how sustainable and well-funded this capex wave really is. After the surge in AI-related bond issuance we discussed yesterday, capital expenditure for AI infrastructure is now projected to climb another 40% to roughly $1.1 trillion next year, keeping this cycle in a clearly inflationary and capital-intensive phase. Nvidia sits at the center of that debate. Its shares are trying to recover from a 7-day losing streak that wiped out more than $400 billion of market value, even as chip peers rebound and futures point to renewed optimism ahead of earnings. Consensus expects revenue above $92 billion with growth around 90% and strong margins, and many forecasts assume another beat, especially in data centers where sales are set to more than double year-on-year. Yet previous beats have not guaranteed upside, because expectations are already so stretched and valuation has been compressing toward broader market multiples. Demand for AI compute still exceeds supply and is expected to do so for the next 4 to 5 years, which supports continued investment across chips, servers, and data centers. Large players are diversifying their funding and technology stacks, from hyperscalers issuing in multiple currencies to partnerships such as Cisco with Supermicro and Google with smaller infrastructure specialists, which have sparked double-digit share price jumps for some of these names. At the same time, competition is heating up. Open-source models are narrowing the performance gap with proprietary systems. Firms like OpenAI and Anthropic are developing their own chips, and there's a growing push toward running more AI workloads locally on devices, led by companies like Apple and Microsoft. Under the surface, AI adoption is proving uneven. Education is one area where AI is already driving revenue, as content providers use it to accelerate publishing and deliver more personalized learning tools, and institutions seek verified, assessment-ready curriculum integrations. By contrast, several established software names have disappointed on earnings and guidance, and stocks such as Salesforce have sold off meaningfully this year as investors worry that AI features are not yet translating into faster growth. Lenders have become more demanding toward business models seen as vulnerable to AI disruption, tightening terms and raising borrowing costs. The bullish argument is that markets still underestimate the scale of the AI revolution, which is already responsible for much of this year's equity gains and could drive an outsized earnings cycle for the largest platforms. However, history suggests it can take 1 to 2 years before a major technology investment wave translates into broad productivity gains. If tangible benefits do not materialize within that window, boards may rein in spending, affecting suppliers up the chain. For now, Nvidia's earnings and guidance, along with the pricing of new AI-related bond deals, are the main signposts for whether this capex boom can coexist with higher funding costs. That funding backdrop brings us directly to the debate around long-term Treasury yields. Long-term U.S. Treasury yields remain the central macro anchor, shaping discount rates for both traditional capex and the AI build-out. After holding above roughly 4.7% on the 10-year and around 5.2% on the 30-year yesterday, yields have eased for a second consecutive session following fresh buyback signals from the Treasury Secretary, but they remain elevated by historical standards. The core tension is between heavy structural supply and attempts at tactical intervention. Persistent fiscal deficits, rising debt stocks, and a surge in long-duration issuance, partly to fund infrastructure and AI-driven investment, are all pushing investors to demand higher compensation for holding long-dated paper. Recent Treasury buyback plans, general account maneuvers, and talk of tweaking issuance patterns are seen by many market participants as signaling concern rather than providing a structural solution. Prominent investors have criticized these steps as distorting the market and undermining the disciplinarian role of long-end yields. In this backdrop, yields near 4.75% on the 10-year are being watched as a psychological threshold, with unease rising as levels approach 5% and beyond. Some investors indicate that a 5% 10-year or a 6% 30-year would attract significant demand, suggesting potential support if yields overshoot. But others argue that current levels are still not restrictive given above target inflation and sizable fiscal deficits. Higher risk-free rates are driving notable shifts in portfolios, with flows rotating from equities toward fixed income and from private equity into private credit, as investors seek more immediate income and demand a larger illiquidity premium. There's also concern about policy credibility. If the Federal Reserve does not deliver a clear, forceful commitment to returning core inflation to 2%, markets may continue to price in a larger risk premium at the long end, especially with oil prices still elevated and AI capex adding to capital demand. Conversely, a strong and credible message from the Fed could help compress term premia and flatten the curve, even if near-term inflation data soften. Another risk is that, in a downturn scenario, lower yields could coincide with falling equities if recession fears dominate, breaking the usual pattern of bonds hedging stock market weakness. For now, the market is debating whether today's high yields primarily reflect healthy nominal growth or emerging dysfunction tied to fiscal stress and policy divergence between the Treasury and the Fed. Key near-term signposts include demand at this week's auctions, especially the $69 billion 2-year sale, the next refunding announcement and issuance mix, and any shift in Fed forward guidance. How the 10-year trades around the 5% area, and how that interacts with funding conditions for AI capex and broader corporate borrowing. will go a long way in determining whether this higher for longer yield regime stabilizes or forces a more aggressive repricing across risk assets. To sum up, sanctions, tariffs, and energy choke points are keeping a geopolitical risk premium embedded in oil, currencies, and select sectors, even as policymakers try to avoid a full-scale rupture. At the same time, AI remains the dominant earnings and growth engine, but the capex boom is colliding with higher funding costs and more selective capital markets, putting a premium on clear returns and disciplined execution. Overall, long-term Treasury yields continue to set the pace, with deficits and term premia keeping rates elevated and driving shifts toward income-oriented assets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.